So we look at a common assumption in the financing of working capital. So this is something is like very important. So in exams, they always ask you either of questions like investing in working capital that we saw earlier and about financing the working capital that we are going to see now. So there are certain assumptions in this financing working capital. The first one is to finance the working capital, you can do it through short-term finance, and the assumption works like this. Short-term finance are very cheap to arrange. So whenever you want, you can quickly raise OD, or you can quickly get a bank loan, or you can get a bank loan. But they're also very flexible. Whenever you want, you can get it. When you can borrow whenever you want, you can also repay whenever you want. But the problem is it is risky and volatile. So why is it like risky? Assume that the cost of short-term finance usually goes up and down and up and down. So you never know like when assume that you want at this point of time the interest might be higher. So you can never predict like where the rate will be keep moving. So they're always risky and volatile. So the opposite is long-term finance. So long-term finance are very expensive because like arrangement fee is high. For example, like preliminary expenses, you issue a debenture, you have to pay legal fees, you have to appoint merchant bankers. So there are like problems here, and it is also inflexible. You cannot like borrow a debenture and pay it like in 1 week and all. So it is like you have to take it has a long-term approach. So it is inflexible, cannot be borrowed, and you can't like pay it whenever you want and all. That's a problem. But the good thing is it is stable. For example, you issue a debenture. The debenture is a 7-year debenture at 10% interest you are going to give. So this 10% is going to be stable for the next 7 years. Okay. So we'll compare short-term finance and long-term finance. Short-term finance are very cheap because in the terms of arrangement, it's cheap. But long-term finance are expensive. Arrangement fees is higher. It's more short-term finance are flexible. Whenever you want, get it, pay it. Long-term finance, not like that. You once you got it, you have to be with it for a long time. Short-term finance are risky. It goes up and down, up and down, and up and down. And this is actually within a 1 year. Okay, within 1 year itself, they're like very volatile. So they can reach a high of like 15. They can also go to a low of 5. But long-term finance are stable because you have launched one debenture for 7 years at 10%. So ensure that you understand these assumptions perfectly. So we'll see what is a permanent working capital. It refers to the minimum amount of all current asset that is required at all times to ensure a minimum level of uninterrupted business operation. That is a part of working capital that you should always have in business. So something like constant level of inventory, receivables, cash that you should always have. Some minimum level of raw materials, work in progress, bank balance, finished goods, etc. For a growing business, the permanent capital, working capital, will be rising. For a declining business, it will be decreasing, and for a stable business, it can remain stable. This part of a working capital, being a permanent investment, needs to be financed through long-term funds. So this is an important consideration. So we look at the temporary or varying working capital. It varies with the volume of operation. It fluctuates with the scale of operation. This additional working capital required during peak seasons over the above fixed working capital. So temporary working capital is above the permanent working capital. During seasons, more production or sales take place, resulting in larger working capital needs. Temporary working capital can be financed through short-term funds, that is current liabilities. When the level of temporary working capital moved up, the business might use short-term funds, and when the level of temporary working capital recedes, the business might retire its short-term loans. So we'll look at this from a picture. So you can have it like this. These are the total amount of assets a company has, and this is over a period of time. So we can put it as like years. Okay. So that is a that is a fixed asset, like what we know. And these are the total working capital. So working capital is split into two parts. One is called as a permanent working capital, and the other one is a temporary working capital. So you might see here the temporary working capital keeps fluctuating. At one point it's higher, at one point it touches the permanent working capital, again it goes up, again it touches the permanent working capital. So that's why it is called as a fluctuating or temporary working capital. So we look at the financing of the working capital. The first approach is called as a matching approach. So the matching approach works like this. The matching approach says that the fixed assets and the permanent part of the fixed assets have to be like funded through long-term funds. So this is long-term fund. This is also long-term fund. But the temporary current asset is like financed through short-term fund. So that is about matching approach. We have next approach called as the conservative approach. So in conservative approach, they say that the fixed assets, the current assets, okay, the permanent part of the current asset are like long-term funds, and this is also long-term funds. But within the fluctuating current assets, okay, a part of it is also funded by long-term funds. Another part alone is like funded through short-term funds. That is, this company is favoring the long-term funds. Why? Because they are a conservative company. What are the features of a long-term fund? They're expensive in arranging, so that's a bad thing. They're inflexible. They're also inflexible. Again, that's a bad thing. But they are stable. But they're a stable source of fund. So the company favors more stability, and it is like trading off the expensiveness in arrangement and inflexibility in repaying. Okay. So that is what the conservative approach is all about. So we look at the aggressive approach. So this says the fixed working capital is used long-term funds. A part of the permanent capital alone is like given with long-term funds. Another part of the permanent current assets is like used with short-term funds, and the entire fluctuating current asset is used with the short-term fund. So this company is favoring short-term funds because short-term funds are cheap, short-term funds are easy to arrange and easy to pay, so they are like very flexible, but they are very risky. So this company is like aggressive. They want the cheapness and the flexibility, they're willing to take a risk. So that's why they are using this kind of a method. You can reach me at my website wowacademics.com, or you can also see my Quora answers. I am active in LinkedIn and in Facebook page, so you can visit at these places. If you just type Sham Prasad and Wow Academics, you will get all these links in Google search itself. And if you like this video, give a like, share to your friends, and if you feel that any points we have missed in this video, you can post it. We will try to give an answer to you in the comment section itself, or we'll also create another video for you. So thank you for watching our video.